So we're talking about tax today, and one of the things that Chapman's are quite well known for is when we meet a new client, we often talk about wills and power of attorney. So we're talking about their death and destruction in the first meeting, and yet they still come on board with Chapman's. But I do think it's really important to think about, what happens at the end of the day, what happens if something goes wrong. And talking about sort of the end of the day, I believe there's some changes coming to do with inheritance tax. Is that correct, Morag?
Yes, we don't know exactly when or indeed whether they will come in, but during the summer of this year, the Office of Tax Simplification issued a report on inheritance tax, which included 11 recommendations to the government. One of those has quite far-reaching implications, actually. So at the moment, spouses can transfer assets between each other with no capital gains tax and no inheritance tax implications. So what you tend to find is that a married couple will have mirror image wills. On the death of the first, all the assets will transfer to the surviving spouse, and we don't need to worry about tax at that point. Clearly then the second spouse owns the joint estate, and that's potentially where you might consider some element of tax planning in order to mitigate future liabilities. So at the moment, when that transfer is done and there's no inheritance tax, along with that, the recipient spouse receives the assets at their market value at date of death. In other words, there's an uplift to their value at the date the first spouse died. So they can then decide at some point in the future that they might sell those assets, and they have a much higher base cost to set against any proceeds that they receive. In other words, there's a much smaller gain.
Because as they crystallise the capital gain of the spouse that's passed away, so say the spouse bought it at say £50,000, it's now valued at 200,000 at the date of transfer, so that capital gain has kind of just disappeared.
Correct.
There's no tax liability on it. They own it from 200,000 value. They decide to do something in 2 years' time. It's now 220. That's
your gain.
Right.
Yes.
Okay. I'm with you so far.
Yes. So that's quite crucial at the moment, because it means that the surviving spouse can potentially do planning without hopefully incurring large amounts of capital gains tax. So one of the recommendations from the Office of Tax Simplification was essentially where a transfer happens and there's no inheritance tax due, that uplift in market value for capital gains tax purposes won't happen. So in other words, the recipient spouse will receive the asset at its very original base cost. So in the example you've just given, that 50,000 will become your recipient spouse's base cost. If they then decided to sell and they got the 220 for it, their gain is considerably bigger.
Yeah, absolutely.
So this has been suggested principally in terms of assets transferring where there are inheritance tax exemptions such as business property relief and agricultural property relief, which wipe out any inheritance tax. But it has also been suggested in relation to any transfer where there is no payment of inheritance tax. In other words, spouse transfers would be caught as well.
And would that also capture, say, husband and wife own a property together, 50-50, and the transfer of the spouse is 50%?
Certainly, if that happened on death, yes.
Right.
Yes.
Okay.
If it happened during lifetime, then at that point it's done on a no gain, no loss basis anyway.
Right.
So the recipient spouse gets it at the original base cost.
Right.
But if it happened on death, then there wouldn't be the uplift.
Right.
So that's quite significant.
Yeah,
and
absolutely.
I think the thinking behind this is that, as you said, that original gain has effectively been wiped out, and they haven't seen any tax due on that. So it's another way to try and extract tax on transactions where we've been in a very fortunate position not to have to worry about that up until now. Now, there is no guarantee that any of the 11 recommendations that have been put forward will be put into play. And certainly, as we're sitting here today, I think the current government has plenty on its mind without worrying about inheritance tax.
Yes, indeed.
But you could see at some point in the future that any number of these may indeed
come under the radar again. Absolutely. So I never thought I'd be grateful for Brexit conversations.
Indeed.
Just as a distraction.
A slight distraction, yes.
So again, we'll just watch this space on that one, and
Yes.
fingers crossed it doesn't come into force too quickly.
Absolutely.
Great. Okay, thank you very much. So thank you very much for your time today, Morag, and for listening to everybody out there. As you'll know from Chapman's, we always discuss a wide range of issues. And if there's any other burning issues that you'd like us to investigate for you or to talk about, then please do get in touch with us. And equally, if you have any tax-related issues, I'm sure Morag would be delighted for you to get in touch with her, and her contact details will be at the end of this presentation.